You're listening to the Real Estate Runway podcast, powered by Collateral Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast. I'm joined here with a buddy of mine, Mr. Harper Jones of Create Tailwind. Harper is not only a friend, a fellow investor. I've actually bought and sold properties from him and his brother. And, you know, he's really an advocate for the infinite banking concept and is a wealth strategist with a company called Create Tailwind. And we'll get into why that name is significant in a moment. He coaches people on how to become their own banker by taking control of the flow of their money. And he uses his IBC system to invest in real estate and other businesses. Harper, welcome to the show, man. How you doing?
Man, I'm doing great. Always enjoy talking with you. And, you saying buying and selling some of the apartment complexes we'd sold to you. It's just awesome seeing, relationships in real life. And, we won on that deal, you won on that deal, and we still have a strong relationship to this day. So it's just awesome to have people that you can be close friends with and not just do a transaction,
Yeah, it was pretty cool. I mean, I think we wound up buying the last of y'all's portfolio in apartments at the time, and y'all did very well. We're doing very well with them, and we've done a lot of things together since then. So it's just kind of one of those lasting relationships that you don't find that many of in business today. So glad to have you on the show. And, Harper, I'm really excited to bring your brain in here because we've talked about IBC, the infinite banking concept before on the show. But what I was always missing before I actually jumped in and started using this as a cash storage mechanism and things like that was really how to tie it into my business, how I'm going to use it to benefit my real estate business. And your background really provides a lot of that connection. So I'm really excited to give you a second just to chat about that real estate background that you have so we can kind of let the listeners connect some dots there. And then we'll get into the IBC concept itself.
Yeah, sure. I think that sounds great. So a little bit about me, been in real estate, I guess around 6 years. I had started out wholesaling and flipping properties, smaller properties, maybe small multifamilies, small single families. And wholesaling would be you essentially kind of bird dog a property, get a contract and flip it to buyers you've kind of already identified and make the difference. Sometimes it could be a little bit of money, sometimes it could be a little bit more. Anyways, did that, had a handful of different partners over a couple of years, kind of stacked up some capital, then started buying some apartment complexes with a couple partners. And some of those complexes, at least half those you guys had bought from us, I guess maybe 2 years ago now. Isn't that crazy? Time flies.
It really is. And we were happy to buy them too.
Yeah, right. And now we've taken our capital. Sometimes we wish we had held them, but we took that capital and rolled it into different assets. Now of which I've been buying a storage facility for my brother. And so we closed on our third today. We'll close on our fourth next Tuesday and looking to keep expanding that, building out a good team, systems, operations. Brother's really helping on operations and management side. And I try to, acquire them and bird dog them, cold call them. But still have some other apartments and single family, some smaller stuff. So just looking to keep building up that portfolio. So that's where I place a lot of my capital and put it to work, as you know, for tax benefits, cash flow, generational wealth. It's just a fantastic vehicle, right, to utilize placing your capital and having, financial freedom and freedom in general. So that's a little bit of my real estate background. I could get more detailed, but we bought and sold other things along the way. Essentially, real estate is my main vehicle that allows me to be financially free and to continue to grow that and, bring some other people in our sphere if we need to keep, scaling up, right, and give them some opportunity to play some of their capital, right? So exactly what you guys do. And over there at Quattro is you guys allow some investors to come in and grow. You guys all win together. So, it's a great mindset. And, at the premise, we're all doing it for the same reason, for the freedom.
That's right. So yeah, thanks for walking us through that a little bit. And, I think that's going to be important as we talk about some of these strategies going forward is the fact that you've also played the game that most of my listeners are playing and probably in more ways, shapes, and sizes than any of us have. So now, Harper, you have been involved for the last, significant portion of your life in coaching people on the IBC concept. So I'm keenly aware that this is something we can go through a lot of rabbit holes on, but if you had to introduce what is the infinite banking concept and why is it important to me as a listener? How would you do that in 5 minutes or less?
Yeah, sure. So, and there's always different ways that I kind of describe it, because I almost describe it different to every person because people are going to receive information a different way. And it's very tough to describe this concept in a short few sentences. You really got to kind of talk about it and then read it and study it to really get the whole picture. But how I would describe it, especially more towards your listeners that have a different mindset, more into real estate, think differently, is just in general, someone is controlling the banking function in your life. So when money flows, it's banking. It's getting exchange for some, good or service, right? And in our lives, how much of that process or banking process do we control? So when you're thinking about money flowing in and out of your life, well, it's great. We don't necessarily want the money ourselves. We want money can do, right? It gives us choices, and those choices, help us lead to freedom, right? But say money's flowing in and out of our lives, it's got to sit somewhere before we deploy it. And guess where we sit it? We sit it at someone else's bank, right? And that could be a checking or a savings account before we deploy it to an investment like real estate. Maybe we buy a car, maybe we finance a wedding, whatever it is. But primarily, we're going to have capital and go buy businesses and assets, right? And money's going to come and go, and it's going to keep going through someone else's institution, banking institution, of which we're a customer, okay? We get a little bit of interest on our deposits there, which is great. We get some benefits, get to see an online portal, get to move some funds around, okay, great. But the dividends and profits of that company or that bank doesn't go to us because we didn't put up the capital. We didn't create the bank, right? So you could say, well, I want to be an owner. I want to start that business because it's the most important business in life is banking, So of course, real estate's a business, buy other cash flowing businesses and you can make some good money, but money keeps flowing in all those different avenues and vehicles. And it's like, how much of that process do you control? It's like, okay, I want to start being the owner of my bank. But to have a brick and mortar bank like the Wells Fargo or a local community bank or something like that, you're going to need a lot of capital. It's going to take a lot of time. And it's just really not too feasible for the average individual. So what we can do is we could divert our cash flows and start our own bank. And a way to do that is to start flowing your capital into a specially designed whole life insurance contract. When that capital gets inside there, when it's with a participating policy with a mutual company, we now are part owner of the company. So the shareholders in a mutual company is going to be the policyholders. There's no excess shareholders that the profits and dividends go to. So what happens is they go to you on your pro rata basis, right? So when you get your cash in there into these policies, you're going to get something called guarantees or guaranteed interest, which is like you as the customer and your deposits, you get your interest, except it's going to be higher in there than it would be at the bank. And then you're going to get dividends and profits at the end of the year if the company issues them. Technically, they're not guaranteed, but they've been paid, for over 100 years, right? So then that would be like the surplus profits and dividends, like the Wells Fargo bank over here would have. So you're creating your own banking system, right? So you got to put up some capital, flow it through your system, and then you're going to get the interest and dividends and profits. But when you're starting to flow money over here to your own banking system, you're going to get a handful of benefits. So if we compare it to where our money's normally sitting in a checking or a savings account to one of these policies, you're going to have maybe interest at the bank, but not as much over here in your policy, right? The own bank you're creating. Interest at the brick and mortar bank will be taxable. Interest in your policy is tax-free. At the brick and mortar bank, your money's not really credit protected. In these policies, it's heavily credit protected. Now it can vary state by state. And the checking account, brick and mortar bank, what's your death benefit? Well, you don't have a death benefit. Well, with this, you're going to have a death benefit. Now, that's not our focus, but it's great to have that protection. And also that protection will pass income tax free to your beneficiaries or business partners, structured properly. Well, yes, your bank account over here, you could borrow against and try to leverage the two, but you don't control that line of credit. The bank ultimately controls it. With your policy over here, you have the ability to borrow up to 95% or more, depending on the time of the year and how close you are to your policy anniversary, against your policy, which means your policy will be growing income tax-free, uninterrupted. and you can still leverage against that, place that asset or that vehicle, that policy as collateral, and start borrowing against it to go put your money to work in another asset, say real estate, for example. So now you get this asset over here that's growing and compounding, and you get the asset over here. Whereas if your cash is in a checking account, it's either the checking account or the real estate, or your stock brokerage account or the real estate, or your savings account or the real estate. In this scenario, you get both sides of the ledger. So to kind of recap here, and then I'll let you ask questions and make sure I didn't sound too confusing, is the policy itself, we're starting to capitalize our own bank. That is the product or the platform. So we're setting up a strong platform that in itself is a great asset and great vehicle. But that platform, that product, that vehicle allows us to practice the process of infinite banking. So infinite banking or becoming your own banker is a process. It has nothing to do with the product. We just pair the two together. So if you think about it, it's like a ledger, credits and debits, assets and liabilities. On the left side, you got your money pool, right? And in this case, we're building up our banking system, flowing our money into a policy. And ultimately, it's a system. It becomes a system of policies. As you have a bank and it's profitable, you're going to have more banking branches, right? On the right side will be your assets and your behavior. So in this scenario, we're buying real estate, or we're investing with an operator who buys real estate, or buying a business, right? And you can borrow against your money pool, go buy the real estate or businesses just like you otherwise would do, except we're pairing the two together, and those together complement very well. And flowing that money across that ledger is really what infinite banking is about.
Yeah, that all makes very good sense. And so, one of the distinctions that it took me a while to pick up actually is we're not doing this to buy life insurance, guys. Like, just pretend that we didn't even say life insurance. It's a nice benefit that it's there. You've heard me talk about the infinite HELOC strategy a lot of times, where you can find liquidity in your home. Let's say you have had a home for 15 years, you've been paying on a mortgage, the value's gone up. Maybe the home's worth 500 grand. Maybe your mortgage is 100 grand. Well, you can actually go collateralize typically up to 80, 85% of your home, maybe even just 75, depending. Well, that gives you around 400,000 that you can use there in a line of credit. The same strategy is there, plus a few more perks. The same strategy is there, if I'm saying this right, Harper, that all we're doing is coming over here and choosing a different asset to collateralize, right? That asset being the life insurance policy. The fact that it's life insurance and the fact that it has a death benefit is kind of an auxiliary benefit. But what we're really looking at is the cash value, and the growth of that cash value is that effectively becomes our liquidity and our interest payments on that money, right?
Yeah. Your equity or your money pool. So you got the two parts of the policy, the cash value and the death benefit. We're focusing on the cash value, and we're focusing on the financing capabilities and the living benefits that vehicle or that policy offers, right? Now, say you do practice this strategy a different way. Well, it just so happens the best platform or vehicle is especially designed whole life insurance contract, is dividend paying, that participates, right? So with a mutual insurance company, I was a little redundant when I said, but good point across. If you do it with a HELOC, well, then say you're still wanting a death benefit and insurance in general, which is smart to have. Well, you're going to have a term cost for that, and that term cost will get very expensive later in life when it actually would pay out. And then also you may be uninsurable by the time you really truly need it. So with this strategy, you also get that death benefit that's going to be ever compounding and growing rolled into it all, is how I look at it, as a bonus. So then that expense for your term now, you don't need, as long as you have enough coverage over here with your system.
Yeah, that makes perfect sense. So let's talk about the ledger example a little bit more. We kind of breezed over it before, but really what we're trying to do here is gain control of the flow of money, right? And just to kind of remind everyone why the flow of money is important, think back to 2008, 2009, 2010, when the banking crisis happened, and all of a sudden money stopped flowing, right? Transactions stopped happening, money stopped changing hands, assets stopped being bought. Some liquidity was lost by banks that went under, right? And so this is the kind of thing where, okay, when everyone else, when your banking livelihood is managed by the banks over here. You can't see my hand over here, right? Versus when you pull it into this own banking system that you create yourself, you kind of almost exclude yourself from, the dependency on these other banks and such. So when we're talking about gaining control of the flow of money, let's talk through that in a little more detail and see if we can get the light bulb to go off here.
Yeah, sure. So let's say, for example, you're having money flow into your bank account, checking account at a brick and mortar bank. Let's just say a Wells Fargo. Money's sitting there. It's really dead. Money's got to flow or it dies. Just like air's got to flow through us or we die. Blood's got to flow through us or we die. It's water's got to flow through us or we die. It's the same concept. Money's just sitting there, or the government even printed $1 trillion, but it sits in one room. It's not going to do anything. It's just dead money. It's got to circulate. It's got to flow. And when it flows, it's banking. It's exchanging for product or service, right? So the money's sitting in the bank, not doing anything for you. So what you want to do is go put that to work, say in an asset, for example, real estate. But while we're waiting for that asset, because obviously, as you know, Chad, it's a tough market right now, and you want to wait for the right deal. So you probably have a lot of excess capital sitting around, right? And you start implementing the system where you have capital sitting there and it's waiting for you, saying, hey, please borrow against me and put me to work and I'll come back with some friends, right? And that's the plan. But what we want to do is have that money working for us 24/7, whether we have a deal or not, and have more control of our money, right? So instead of having it sitting at a brick and mortar bank and Wells Fargo lending out our own money and potentially our own money back to us, where we're paying interest for it, let's start diverting that in our own bank. So as we keep having capital go back into our own bank, is now going to be earning interest versus no interest, all tax-free and compounding. And then let's actually talk about the infinite banking part here. Say policy, your cash is sitting in your policy. Let's say we have 100 grand in cash value, right? And we have a real estate deal. And you're like, okay, I'll go buy a $200,000, fourplex, if we can even find those anymore. Then for that price range, you're like, okay, I put 25% down. So I'm going to borrow against my policy. I'll take a policy loan for $50,000. Okay. So then they'll place a lien on your policy and they'll send you a check for $50,000. They, as in the insurance company, send that to your brick and mortar bank. 50,000 shows up in your bank account and you can take that 50, go take a title company, go buy that real estate, right? So use the bank money for 150, your money for 50. Now your benefit here is that's not your money you put to work. So technically you have no money in this deal because you took the insurance company's money, OPM, right? Other people's money as the down payment and closing cost, and you use the bank as the other part they loan. So you technically have none of your own money in there. What you do have in that deal is just the interest on the dollars you'd borrow from the insurance company. But your dollars are still sitting in your own banking system in that policy, compounding and growing, tax-free, right? Yes, there's going to be a cost for borrowing because it's not your money you're borrowing, but you're fully controlling that policy loan or line of credit, right? And now your money's getting put to work over in this asset and you have this asset. But keep in mind, we have 100,000 in cash value, 50 we put a line of credit against, or policy loans, what's it called. So we still have 50 more we could access for another deal. But keep in mind, we have an opening of 50,000 in a line of credit. So with real estate, guess what we have? We have escrow, property taxes, insurance bills, maybe excess reserves we got to keep, whatever that may be. Well, guess what you do with that? You may have the bank escrow it. You may sit it in a savings account or a checking account, but you're not going to take that money and go invest it because you don't know exactly when you get those dollars back and you got to pay that bill, right? That comes due every year. Well, why don't we take those funds over here, divert them back to our policy to pay down that line of credit? So then we're going to have less interest charged and recapture more interest on our dollars. And then when that bill comes due, take another policy loan for 20 grand, 30 grand, 40 grand, whatever it is. And as you keep growing your system, you're going to have loans come and go. You're going to have maybe 3 loans out for deals, or 4 or 5 or tons. And then at that real estate, if you're buying it properly, you're going to have good cash flow and you may refinance or sell the property. But what happens when you do that? Your money comes back with friends. You go pay back your policy. I have excess cash in my bank account that I can't fit in my policy. I need to expand my banking system. and you open up more banking branches and keep growing this to where money's flowing back to you, which is what you want, and which is great about real estate is money's flowing to you. But when it's flowing to you, where does it sit before you resend it out and deploy it? Are you sitting in your own bank, or are you going to sit in someone else's bank and let them lend it out?
That makes perfect sense. And I think why I love talking with you so much, Harper, is I just had another light bulb go off when you were talking about this, because I fully understand, and I think a lot of people do, that deposits are effectively loans you've given to a bank, and they're paying you a little tiny bit of interest, right? And so and then they can go lend it out. Now, this is the one thing, if you guys figure this out, then let me know, because if you can figure out how to let me put one of my dollars into my bank and then lend out 10, that'd be great, like the real banks do. But unfortunately, it's 1-for-1 for us folks. We're not that special. But what's cool about what you just said is your money is actually staying in your policy and growing at whatever contract dividend rate is happening, right? And maybe above that, depending how the mutual company is doing, because you share in the profits. The money you actually take a loan from the insurance company is their money. You're paying them a little bit of interest for it. And let's say it's 4%, whatever the number is. So if it's $100,000, that's $4,000 a year. You actually don't have $100,000 in that real estate deal. You have $4,000 in that deal, technically, because your money's over here growing. So it's another way to think about it in terms of using other people's money that you control to acquire an asset.
Yeah, exactly. And someone could say, well, I'm taking the policy loan and say the interest is 4% for the year. If you had 100,000 outstanding the whole year at 4% and didn't have other money flow in like the escrow and whatnot, which I'll circle back to, it'd be that 4,000, right? But if you use it for a business purpose, I'm no CPA or attorney, but can't you write that 4% off because it's interest paid? And then don't you also recapture interest in your policy right now while it's compounding, and say it's between 3 to 5%, depending on the year and the dividend, even if it's 3.5%, where it grows even lower, which I'm being very conservative, then that actually offsets, because one, it's compounding, and two, it's tax-free. So really that's compounding at 5% or more, right? Because it's tax-free. And the 4%, say you write off for a business purpose, check with your CPA or attorney, right? And then you also got to factor in, that's if you had 100,000 outstanding the whole year. Well, if you start having cash flows at month 6, and you start sending it back to your policy, you have a diminishing policy loan. So then maybe it's 3% in the year instead of 4, or you're doing the escrow strategy, which we have a lot of real estate people do the escrow strategy and build their system up. And now what's your policy loan interest rate? Maybe 2, maybe 1.5, maybe 3. You don't really know, because it's a system. And when you start thinking about it conceptually as a system, not a one-off example, it starts really making sense.
So Harper, we've spent a lot of time kind of talking about the product and the process, and almost went down a rabbit hole of how we can use this thing, but you can thank me for that later. How can the listeners go and really dive into the meat of this? Because you really have to read it. You have to internalize it. There's a certain book I know you advocate for. How can the listeners get their hand on that book?
Yeah, sure. So the book you're referencing is Becoming Your Own Banker, written by Nelson Nash. And that is really the foundation and framework of infinite banking. And I always have this offer out there. Anyone who wants to understand and learn and read it, I will mail you a copy of Becoming Your Own Banker. Just shoot me an email at harper@createtailwind.com. So that's HARPER@createtailwind.com. And I'm happy to talk with you, get the book out there, and answer any questions you have. There's plenty of other resources. I would advise you to not just hop on the internet, because just like with real estate, people say real estate's terrible. People say it's great, right? You've heard of Dave Ramsey, pay all cash or don't get into real estate, right? But you want to make sure you're looking in the right avenues and what to do. So I can help send other resources further. I just say start with Becoming Your Own Banker. Read that. We can reconnect, and I have tons of resources to dive more down a business owner rabbit hole, escrow rabbit hole. How could I finance this? Could I use policies on my kids and grandkids and business partners? And well, what about a universal life? And like all these things that you don't want to get into. Like, don't worry about those details. Understand the concept first, and then everything will kind of flow after that.
Fantastic. Well, Harper, before I let you off the call, there's two more questions you have to answer. You already told us about the book part, so I'll let that one slide, right? But what is your biggest superpower in this business, if you had to pick one?
I would say I think I'm pretty good at relating to people and talking with people. I'm pretty outgoing. And I think it helps, not necessarily in infinite banking and trying to think about how to present it. So like you said, if someone asks me about infinite banking, depending on the person, if I know they're in real estate versus maybe a high W-2 owner who doesn't understand real estate, I'm going to present infinite banking two totally different ways to try to relate to them. And then same thing, cold calling with property owners and real estate. I try to get to know them and build rapport and not just say, hey, do you want to sell? I try to really build a conversation and get to know them and say, hey, would you ever be interested in selling, at the end, and just kind of just make them save my number in their phone. So then in the future, when I reach back out, my name comes up on their phone versus a random number. So I would say, I think I would have a strong suit there, but I could totally get better. And I'm always going to try to get better. I'm not perfect by any means in that field. And there's tons of weaknesses I have that I'm not very good at, but I think that's something that I was gifted in.
I second that for sure. And I don't know if I get the trophy for being your toughest client at all, but it took us a long time of talking through this stuff and me asking penetrating questions but you were able to relate to my perception, my perceived view of the world and how you described it to me, being the infinite banking concept. And it finally clicked. I mean, I think we were on a call, 2 or 3 months ago when I finally was like, oh, I get it. Okay, here's a couple $100,000. We need to do this, right?
Yeah.
So it's I would agree with that.
Yeah.
All right. Second question. If you had to pick one failure in life, what was it and what did it teach you? Biggest one.
There's been, I think, 2 real estate deals or 3 where we have lost a little bit of money on, and nothing was substantial. But the only reason we did was not because they were bad projects. It was because we lost focus. And so say we were, remember, when we sold you those apartments, we were buying and managing apartments. So we self-managed. We bought the apartment, so we operated it. And we also kind of had a wholesaling arm. We had like 3 things going, which was great. And we made money. It was good. And we learned. But if we would have focused on one of those or 2 of those, we would have been able to scale and grow up more and maybe add another 0 to some of those exits, right? And that's totally okay because, you're living and learning and we want to apply. But of the deals, I guess is maybe like 3 or so years ago at this point, we had this one deal. We took on a commercial building, another house, and basically we just kept losing focus going back and forth with different avenues. And that's what caused us not to maximize those deals or have to let one go because we had so much going on and then not be able to capitalize on it. So like, for example, one deal we bought it for like 85, put 15 in it and turned around and sold it for 85 because we had so much stuff going on. And so in the big picture it was fine, but now our buddy, that thing just appraised at like 600 after you put 100 in it. So it's like been a couple of years of the market, but it's like, and I'd start a lot of people listening like, yeah, I know that deal. But if we would have focused, I think that we would have been able to capitalize on that deal and more deals, or decide to not take it on in the first place, right? So focus on your vision and what you're truly looking for, and work towards that and say no to things that don't get you there. That was very long-winded, but
I think it's very valuable. And I mean, it's, you can build a river and have tributaries feeding that river, but it's, and I would even argue your businesses were still pretty close together, but the point is you had your attention in too many places, right? It becomes even harder if you're in real estate over here and you're trying to manage, I don't know, what am I trying to say? A car dealership over here or something like that, right? You get in too many places. So I totally get that. All right. Well, folks, as Harper mentioned before, we have his email and his website in the show notes. Just scroll down. If for some reason Apple's been cutting off the show notes, hit episode website at the very bottom right, and you'll get all of it in its ever glory. So you can contact and reach out to get a copy of Becoming Your Own Banker. the book, and also just to pick Harper's brain on, all the different ways that you could possibly use this strategy of controlling your own flow of money to further benefit your own financial goals. So Harper, thank you so much for coming on the show. I always enjoy talking with you, man. And I don't think we've had a single conversation about this, including this one, where I haven't learned something. So thanks for coming on.
Yeah, sounds good. Thanks, Chad.
All right, everyone. This has been another episode of the Real Estate Runway Podcast. Until next time, over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.